Okay, we're now going to take a look at a bank reconciliation for Copperfield Entertainment. You guys, let's first talk a little bit. I'm sure you've already read about them, but let's talk a little bit about the purpose of bank reconciliation and what we're doing here. Um, Anytime a business has a checking account, and most all businesses would, we want a paper trail of deposits and disbursements from the account. Um, the business itself would keep up with a checking account balance, like Copperfield Entertainment, and here are their records for the month of May 2024. And then the bank would also keep up with that checking account balance. And we can see that from the bank statement here, also for the month of May. Okay, and we don't really need this address and all this information, so I'm going to scroll down so we can see a little more of it. So each party is going to record transactions that affect the account when they're aware of them. Okay, so for Copperfield, when they make a deposit, they're going to record the deposit that day. When they write a check or use a debit card, they would record that in their records that day. The bank will only record deposits made by Copperfield and checks written by Copperfield as they process through the bank. And there's not as much of a timing delay there with deposits as there once was, but let's say, for instance, if a business made a deposit on the last day, so here are the cash receipts that are all deposited by Copperfield, and here's one on May 31st. So if this one's made late that night, maybe at the night drop at the bank, something like that, Copperfield would add it to their balance on the 31st, but it might not process through the bank until sometime in the next month. And once a month, the bank prepares a bank statement to mail out to their depositors. So that would create a timing difference. There's two reasons why these balances might be different at the end of the month. There could be timing differences, meaning either the business or the bank knew about a transaction first and recorded it, and the other party, either the business or the bank, wasn't aware of it yet and could not have recorded it yet. So those timing differences, we're not really concerned with those because in time they'll work themselves out. So like the business is going to deduct checks from their balance when they write the check, deduct a debit card transaction from their balance when they use a debit card, and they're going to add any deposits to their balance when they make the deposit. Well, all those are not going to appear immediately in the bank's records. And when the bank cuts off recording of transactions at the end of the month and prints the bank statement on May 31st, there could be some transactions recorded by the business that the bank has not recorded yet. Also, on the bank statement, there could be items that the depositor doesn't know about until they receive the statement. So those items would be recorded first by the bank, right, and shown on the bank statement, and then the depositor would record them in their records when they receive the bank statement and become aware of it. Things like service fees. The bank's going to know about that first and record it first. So what we want to know is, why are these two balances different? So let's first look at the May 1st balance. It's $5,410 according to Copperfield. According to the bank, the balance at the beginning of the month was $6,130. So let's punch that in our calculators. Okay, so we had 6,130 minus, that's the balance according to the bank at the 1st of May, minus 5,410. And that's a $720 difference in the beginning balances. Right, the bank's balance was more. Well, if we go to this additional information they give us, on A it says the difference in the beginning balance in the company's records and the bank statement relates to checks 469 and 470, which were outstanding at the end of April. That just means Copperfield wrote those checks in April and deducted them from their balance in April. But they didn't process or clear the bank, and the bank did not record them until May. So they showed up on the May bank statement, even though they were recorded in April by Copperfield. So if you look for those checks here on Copperfield's May records, you won't see them, because they deducted those checks in the month of April. But let's look for those two, 469 and 470. I bet they're here. There you go. 469 and 470, those were outstanding at the end of April, but they cleared here at the 1st of May. So those checks no longer represent a difference in the two balances. That's an example of what I was talking about earlier, a timing difference that in time worked itself out, right? These two amounts were deducted by Copperfield in April, and they cleared the bank and were deducted by the bank in May. Now let's go back to the calculator here. Those two checks total, $720, and that's our amount here. That's why these two beginning balances were different. So the only reason they were different was because of two outstanding checks at the end of April, and those cleared in May. Now, if these two didn't show up on May's bank statement, then they would be outstanding checks or checks recorded by the depositor that have not yet cleared the bank, again at the end of May. But since they showed up here, you don't have to worry about them in May. So we're finished with 469 and 470. Okay, we're only looking for differences in the two balances, and those two checks were recorded in the month of April by Copperfield. They've now cleared the bank in May, according to the bank statement here. So we don't have to worry about those. They've now been recorded by both parties, in other words. Okay, so we can move along from A there. Now they give you a nice code here that tells you what all these abbreviated items are on the bank statement. DEP is for deposits, INT for interest earned, SV for service fees, note for a note collected by the bank. Now that could be the note collected a bank for the business, added that to their balance, and the depositor didn't find out about it until they received the statement. CHK stands for a customer check. NSF, non-sufficient funds. Now, business could receive a check from one of their customers, deposited at the bank. If that check turns out to be no good, the bank would deduct the amount deposited on the check, plus generally a fee on top of that. Then we would try to collect that again from the customer. The EFT stands for an electronic funds transfer, and then DC is a debit card transaction. So what we're going to do here, you guys, we'll need this other additional information about the error in a minute. We want to determine why these two ending balances are different. Now on the bank statement, it's 6587 and only 5360 according to the company's records. Now the difference in our ending balance again is due to either timing differences, either the business or the bank knew about a transaction first, recorded it, and the other party was unaware of it at the end of May, or there could be errors by the depositor or by the bank. And that's really what we're trying to do here, is run down those errors. So if you take care of all the timing differences and your two balances don't match, then we have an error either by the bank or the depositor. Those can take some time to figure out. Now, luckily for us, they tell us here what the bank made the electronic funds transfer on May 20th in error. And that's the 470 here. We'll come back to that. Now, if the error was made by the bank, it'll be an adjustment to the bank's balance. Of course, if the error was made by the depositor, it'll be an adjustment to their balance. So we're required here, or our instructions ask us to prepare a bank reconciliation for Copperfield's checking account on May 31, 2024. Well, we have a nice little form for that here. And we'll just start by entering the balance according to the bank on the bank statement and the balance according to Copperfield from their general ledger. So I'm going to go up and pick up the bank balance here. It's the ending balance, $65.87. Now let's go up and pick up the company's balance, $53.60. And once we determine all of the reasons why these two balances are different, we'll adjust each one as needed. And we should be able to come down to the same balance, bank balance per reconciliation and company balance per reconciliation. Those two should match when we have completed what we need to do. So on adjustments to the bank's balance, we want to add any items that Copperfield had already added to their balance that the bank had not added to their balance on May 31st. So mainly what we're looking for there are deposits. So let's go up and look at deposits made by Copperfield. We had one on the 3rd for $13.30 and one on the 10th for $17.60. I would assume the bank has recorded both of those because they occurred early in the month, right? But let's check and make sure. So we should see a $13.30 and a $17.60 on deposits. Here we go. $13.30, $17.60. All right, so both of those deposits were recorded by both the company and the bank. So they don't represent a difference in the two balances. Let's just keep going down our list here. The next deposit was $23.90 and $28.60. $23.90 and $28.60. Both of those were recorded by both parties, so they don't represent a difference. Let's check out this last one, though. When you see the deposit was made on the last day of the month, there's a decent chance that it may have been recorded by the business, but not yet recorded by the bank by the time they prepared the bank statement. So that one's for $3,050. And we notice here the bank has not included that in their balance. So that amount has already been added to Copperfield's balance. The bank has not added it to theirs. So to get the two to match, it's already been included here. We need to add it to the bank's balance. So I'm going to call that deposit in transit. You could also call it outstanding deposit. We're going to add that to the bank's balance because it's already been added to the company's balance. And of course, I forgot what it was by the time I scrolled down, but $3,050 here. We'll put that in right here. Okay, checks work in a similar manner. Again, the company is going to deduct a check from their balance as soon as they write it. The bank won't deduct them until they process through the bank. So let's look at the checks here. There's only two. Copperfield wrote checks 471 and 472. Well, let's see if both of those are on the bank statement. I'd say there's a good chance they're not, because look at when they were written. The 30th and the 31st didn't have a lot of time to go from the party that Copperfield wrote them to and clear through the bank before the statement was cut on the 31st. But let's look for 471 and 472 on the bank statement. You guys, they're not there. The only two checks were those ones that were outstanding at the end of April. And again, those have now been recorded by both parties. So both of these checks represent a difference in the two balances. We got check 471 for 420. So I'm going to call those outstanding checks, and that's not just my term, that's standard. And I'm going to put in parentheses here which ones they are. It was checks 471 and 472. And I'm going to put the total here. We might need to go back to our calculator, but we got 420 and 3470. So that's 3890 added together. And we'll enter that as a deduction. 3890. That's just the two check amounts added together. Now we also know from the additional information that the bank made an error. You guys, either party could make an error. I'd say it's more likely for the depositor to than the bank. The bank has a lot of controls. But this bank reconciliation is an internal control for the business. It helps them keep up with cash to the penny. You guys, I'm getting off topic a little bit here, but it's important for the business to keep up with cash to the penny on a daily basis. And you probably know why without me elaborating any further, but it's because if someone is going to steal from the business, maybe an employee trying to pull some type of embezzlement scam, they're probably going to take cash, right? I mean, if you were going to steal from your employer, wouldn't you rather have cash than office supplies? You know, if you stole office supplies, then you'd still have to sell them, right? So we have tighter controls over cash than probably any other asset, because cash is most susceptible to theft. It's what someone that's going to steal from you, it's what they're looking for, right? Cash. All right, so this helps us to know that there's not any impropriety, right? Okay, so we know we had this error by the bank. Now, you guys, if the bank made the error, it will be an adjustment on this side to the bank's balance. If the company made the error, it would be an adjustment to the company's balance. Now, when we note a bank error, one thing we need to do is pick up the phone and call the bank, or maybe go down to the bank and let them know. But here they tell us what the bank made the electronic funds transfer on May 20th in error. The bank accidentally charged Copperfield for a payment that should have been made on another account. Okay, well, there you go. This 470 should have never been deducted from Copperfield's balance, but the bank did deduct it from them. I don't know about you, but if that were me personally, I would notice 470 missing out of my account. But a business with larger account balance than I would have, they might not notice it, right? But they figure it out when they prepare this bank reconciliation. So how do we correct the error? The bank deducted 470 when they should not have. So to correct that, we need to add it back. So I'm going to call that bank error on electronic funds transfer. They deducted 470 much was it here? Let's see. They deducted $470 from Copperfield's balance when they should not have. So to correct that, again, we've got to contact the bank, but we want to add it back here. Now, I believe that those are going to be our only adjustments to the bank's balance, but let's go up and look to make sure. Now, how do we know? Let's go back up to the company's records. We've already checked the deposits. We listed the one that the bank had not recorded, the one on the 31st. We also listed these two checks. They have not processed through the bank yet. They're going to be a deduction from the bank's balance. But I believe these 4 debit card transactions have processed. I'm assuming they have because the latest one was on the 22nd. But let's check to make sure. We got 1170 and 1540. Debit card 1170, debit card 1540. Those both were recorded by the bank and the depositor. Another debit card transaction here for 3470 and for 1370. 3470 debit card and 1370 debit card. So that takes care of all the adjustments to the bank's balance, you guys. So now we can total it up and get an adjusted balance here, or reconciled balance. So I'm going to bring my calculator back up. And I believe I'll move it over here. Okay, so we've got 6587 plus 3050 minus 3890 plus 470. So we get 6217. Here is our adjusted balance. Now, when we make all of our adjustments to the company's balance, we should come to that same amount. All right, now what we're going to look for are items on the bank statement that the company has not recorded by May 31st. Now, one difference, again, that you're going to run into are these checks 469 and 470. But you guys, they're not going to show up on the bank reconciliation. They were recorded in May by the bank, but the depositor recorded those in April, right? They were a difference in the April 30th balance. So don't let that trip you up. That gives people problems sometimes, but those two checks would have been recorded by Copperfield in April. They didn't process through the bank until the beginning of May. Now let's look for other items that are different here. We've taken care of all these regular deposits. All right, see up here we've got 1, 2, 3, 4, 5. We know this one was not yet recorded by the bank. So we should see 4 regular deposits here. 1, 2, 3, 4, right? 1330 and 1760. We've already checked this. 1330 and 1760. Then 2390 and 2860. Here and here. Now, what are these other two deposits? It looks like on the 20th, the bank collected a note for Copperfield. You have to kind of play along here a little bit. I really feel like in today's age, if the bank collected a note for the depositor, in this case Copperfield, would have probably looked online and noticed that before they received the bank statement, but we're going to pretend they didn't notice it until the statement came in. And you might be wondering, why is the bank collecting a note for Copperfield? Well, the bank's in the business of collecting notes receivable. Copperfield's probably not, so the bank might collect that for them. But anyway, the bank did, in this case, collect an $1,100 note. You see that here on the 20th. That included interest of $47. So that has been added to the bank's balance, has not yet been added to Copperfield's. It's going to be an adjustment here. Note collected by the bank, including was it $47 in interest? Yes. All right, so that's going to be an addition of 1,147. All right, then we also just had some interest earned on the checking account, $17. The bank has already added that to their balance. To get the two to match, we have to add it to the company's balance. Now let's look for items that the bank deducted that Copperfield had not yet deducted by May 31st. Well, these two checks were both deducted by Copperfield in the previous month, April, so you don't have to worry about those. The debit card transactions we've already checked. Here we go. We got a non-sufficient funds of $270. What happened there, you guys? We just received a check from a customer for $270. We deposited in the bank, and the check turned out to be no good. So what's going to happen there? Well, Copperfield added it to their balance, that $270, when they deposited it. So to correct that now, that the check turned out to be no good, that will have to be deducted from the company's balance. And not only will they deduct it here on the bank reconciliation, they're going to add it back to that customer's accounts receivable balance and continue to try to collect it. Probably with a service fee on top, too. Now that was non-sufficient funds of $270. Copperfield had already added it to this balance. The check turned out to be no good, so it'll have to be deducted. So that takes care of this non-sufficient funds charge. And the only other thing we've already taken care of the electronic funds transfer. Remember, that was an error by the bank, an adjustment on that side. The only other item we have is a service fee of $37. If you're like me, you might think, wow, that's a large service fee. I think normally $10, $15 service fee. Probably the rest of the service fee was for collecting this note for them. I'm going to assume the bank probably doesn't do that free of charge. But anyway, we get a $37 service fee. The bank has deducted it from their balance already. Copperfield didn't know how much it was until they received the statement. We got a service fee here. The bank has already deducted it from their balance. To get the two to match, we'll have to deduct it from the company's balance. We got service fee. You guys, you can use the abbreviations from up above if you want, but I just typed it out. That's going to be 37. All right, now let's bring back our old trusty calculator here. I hope you all are doing well. Hope you're enjoying the course. But even if you're not, I hope you do well in it. Just put in some time and effort. You should be fine. It's my little pep talk for this problem, I guess. We'll start with the 5360. Plus 1147 plus 17 minus 270 minus 37. And would you look at that? How beautiful. Comes out to 6217. which matches our amount here, and that's what we're looking for. All right, so we have determined why these two balances were different, you guys. Now, the deposit in transit and the checks were both timing issues. The company had already recorded them. The bank will record them the next month. The note collected by the bank was a timing issue. The bank had already recorded it. The company didn't know about it till they received the statement. So was the interest earned on the checking account. Bank has already recorded it. Copperfield didn't know about it till they received the statement. The non-sufficient funds charge, also a timing issue. The bank has already deducted it. Copperfield found out about it along with the service fee when they received the statement. The only one that represents an error was an error by the bank. Now, had the company made the error, it would be an adjustment to the company's balance. And you guys, of course, to correct an error, you have to figure out which way the error went and do the opposite to correct it. So in this case, the bank deducted $470 from Copperfield's balance when they should not have. To correct that, we'd have to add it back. If they had added an amount to the balance that they should not have, then we'd have to deduct it to correct it, of course. All right, now, to wrap this thing up, we're going to make some journal entries. Now, just think about it for a second. Which ones are we going to make journal entries for? Adjustments to the bank's balance or adjustments to the company's balance? Well, I hope you said the company's balance. Of course, the bank makes their own journal entries, right? So anything that's an adjustment to the company's balance, we'd have to record in journal entry form so it updates to the cash account and other appropriate accounts. So I'm going to start with a note collected by the bank. You guys, any additions here, of course, will be a debit to cash. Any deductions here will be a credit to cash. You just have to figure out the other side of the entry. I'm going to start here with the note collected by the bank. Will that increase the cash balance? Of course, cash is an asset, increases on the debit side, $1,147. We'll credit notes receivable, the asset that would represent what someone owes us on a loan that we made to them. It would come off the books at the principal amount, which was $1,100. We got that up here, remember? $1,100 was the note itself. $47 was interest on that note. We got interest revenue for $47. That takes care of the note collected by the bank. I could have combined those. I didn't combine them though. I think it might be easier to see your first time through if we do each one in a separate entry. So I made my general journal a little larger here. Interest earned on the checking account, well, that would increase cash. I like my font to be a little larger there. So that would increase cash by $17. And that's going to be a credit to interest revenue as well for $17. Let's make them all 12 point there. You can probably see it anyway. When you get to be my age, you need a little bigger font or reading glasses one, and I have yet to buy the reading glasses. So anyway, I can just increase the font here, but I digress. Let's get back to the topic. The non-sufficient funds charge, again, that's where a customer gave us a check for amount they owed us, I'm assuming on account, and the check turned out to be bad. Well, they still owe us that amount, so we're going to when they paid us and we deposited the check, we would have debited cash and credited accounts receivable to increase cash and decrease the accounts receivable balance for that customer. If the check turned out to be no good, then we want to increase accounts receivable by the $270. We're going to credit cash for $270. Now, hopefully later on they'll pay us and we can flip that entry, debit cash and credit accounts receivable, when they pay us in cash or give us a check that doesn't bounce. And then on the service fee, well, that's going to be an expense for the business. Sometimes we see miscellaneous administrative expense. We might include it there. You could see service fee expense. It just depends on what account that particular business wants to use. I'm going to go with that one. Service fee expense. But again, a business might not care enough about tracking that to set up the separate expense account, so it could be lumped in miscellaneous. But we'll go here with a separate account. So we're going to debit the expense account to increase its balance by $37 and credit cash to decrease it by $37. All right, so again, you guys, on these adjustments to the company's balance, anytime we're adding an amount, notice that's a debit to cash. Anytime we're subtracting an amount, that will be a credit to cash. And then you just have to determine the other side of the entry. Now, we could have combined some of these. I think you probably see here we could have taken these two debits to cash and added them together. And we got two interest revenues here too. We could have added those together. But again, I think as you're learning to do this, it might be a little easier to see doing a separate entry for each one. But they could have been combined, and you're welcome to work it that way too. All right, I hope that helps, and give the other one there, the other handout problem a try, and you can check it by the solution. And if you have questions, please be in touch. Thanks a lot.